Hello and welcome to the Australians Money Puzzle podcast. Welcome back, I should say. It's the first episode of the new year, so welcome aboard, everybody. I hope you've been enjoying your summer break, and I hope that you've also had time to listen to our summer series on collectors, which I certainly enjoyed putting together. It was great fun. If you haven't listened to it, it's all there on the app. You can learn how to collect cars, wine, rare books, art. Very, very interesting, and maybe apart from having fun, you might make some money as well. Now, I don't know about you, what you've been doing, but in the last few weeks, I've been doing what I always do this time of the year, which is to take a look at my portfolio, my assets, what I'm doing, how my SMSF is structured, is the balance right? Did I make the best of it last year? And more importantly, am I in good shape for the year ahead? To help you do the same thing, I think the best way to start the year is to have a look at property settings for the year ahead. What can we expect from the property market in 2024? And to do so, I have the ideal guest who, it must be said, did something very similar last year to great success, actually. And I know it was one of the most popular shows of the year. It's Stuart Wemyss from ProSolution. How are you?
Oh, fantastic, James, and Happy New Year, and Happy New Year to all our listeners.
To you.
Yeah.
Great to have you on board again so quickly, because if you remember, Stuart was with us at the end of the year. Okay, so I've actually been, both of us, I suppose, have been looking at the numbers, what happened last year, or what's expected to happen this year. Just briefly, just to recap, so everyone's across this. Property prices went up 9% across the nation last year. In some cities, they went up double digits, like Sydney. Melbourne, way, way, way behind, maybe 3%. Perth came alive. What do you think? Will that pattern continue this year?
I think so. I don't know of anything, or can't think of anything, at least that's occurred yet, that would disrupt that pattern.
Including Melbourne dragging the chain?
I think so, and it's something that was a really good episode that we did, and something I've been thinking a little bit deeper about really over that Christmas, New Year period. And in terms of what is contributing to that differential in performance. And the other things I could really put my finger on mainly to do with the Victorian government in two ways.
The imposition of taxes.
Well, that's right. The first one is the level of debt. And I guess then investors think, oh, well, hang on, who's going to repay that debt? And Victoria, like every other state, earns more than 50% of its revenue from the property market in the form of land tax and stamp duty. So I guess then property owners might end up picking up the responsibility for repaying that debt at some point. And then the second one was that the Victorian government, maybe all governments to some extent, can be a little bit militant, a little bit sort of. They don't really necessarily take a lot of input from industry. They come up with their policy and they implement it. And so again, I guess that people thinking about investing in Victoria, that's a concern.
Okay, right. So that's why you justify, if you like, that outlook. Let's just talk about big picture for a minute. Seems to me the consensus is that prices will continue to rise in the year ahead. By the way, this is all speculation. Nobody knows what's going to happen.
No, of course not.
Always worth pointing out, because last year it did 9% and it wasn't supposed to do anything. But for what it's worth, the consensus is nationwide we should see 3 to 5% growth in prices across the board. That would be about coming up on half the pace of last year. There's the consensus that rates may have peaked, but I wouldn't be waiting for them to drop. And inflation, if you're an investor, 4 or 5% perhaps. And so that's interesting. That means your yields would possibly still be below inflation, which means you're still trying to get the property price to make your numbers. Yeah,
that's right. I think in terms of, the good question is, what do we need to see growth, to see stronger growth? And then the question is, once you identify those factors, we can form a view on whether they're likely to occur. Well, the first thing is that we need an easing in borrowing capacity, which can occur in two ways. Either the RBA starts cutting interest rates, and of course that helps everyone's borrowing capacity and cash flow. Secondly, that the APRA can relax some of the credit policies, particularly around
the
interest
buffers.
rate buffers and
Right.
those sorts of things.
But that's something it would make sense to review, you would think, now that we have apparently turned the corner. Okay, yeah.
But actually, James, in 23, owner-occupier lending increased by 10%, investment lending increased by 27%, albeit off a low base.
It was a very low base.
Pretty low base.
Yeah.
So will the regulator want to relax credit policy? Not on those numbers, I wouldn't have thought. I think the regulator would look at that and go, well, it's not like lending's tight, like there's still people borrowing. The problem, however, is it contributes to wealth inequality. The rich people are borrowing. The people on high incomes are borrowing. There's no problem there.
Yeah.
But unfortunately, there's a large cohort of Australians that are locked out of borrowing and therefore locked out of doing things like upgrading their home, getting into the property market, investing, those sorts of things.
Yeah, right. And on the buffers, just to explain to people, the buffers, what we're referring to on APRA, just in case it's unclear, is that when you go to borrow, the price on the window for the bank, it might say 5.5%, but the buffers are this rule from APRA, the regulator, that the bank must assume much higher than that. They must assume, maybe work out about 6.5%?
Yeah, 3%. So if you're an investor borrowing on an interest-only basis, you're paying 6.5% to 7%.
Yeah.
They'll add a 3% buffer.
They add 3.
So it's almost like they're testing your ability to repay if interest rates got to 10%.
Yeah. So if you're going into a bank saying, I can afford 5%, you're on the wrong track because the bank has to assume 8 because they have to add 3.
Well, 5% would be for owner-occupier at best.
Yeah.
But investors obviously attract higher interest
rates.
Yes.
Yeah.
But yeah, you're right. You're exactly right.
So an investor would be looking at 6 or 7 plus 3.
Yes.
So they're being assessed at 10%.
Yes. Yep. So to borrow $1 million, the repayments are circa $110,000 a year.
Yeah.
On that benchmark interest rate.
Yeah.
On a principal interest basis.
Yeah.
I mean, there's not many people that can demonstrate their ability to be able to meet those sorts of repayments. And that's why I say the rich are getting richer. And the poor, unfortunately, are kind of, or the less wealthy are locked out of the property market.
And no wonder investor activity is suppressed.
Yes.
So what you're saying is this was put in by the regulators when rates were rising quickly. And it would seem to, from a layman's point of view, make a hell of a lot of sense to review this now, since rates are not rising any longer, not to mention they may soon be falling.
A 3% buffer is definitely required when interest rates are 2%.
Yeah.
When interest rates are 6 or 7%, I think arguably need less of a buffer.
Okay.
So I think keep the buffer, but then put a cap. Add a cap. Say we don't need to test greater than 8.5% or something like that, on the basis that the probability of exceeding 8.5% is pretty low.
Okay. Very interesting. That's something that we'll come back to. That's going to be news during the year, I think, whether they change the buffers. Now, something you've drawn my attention to this morning, talking about when we look at what everyone's saying about the year ahead, there's this assumption, there are various assumptions. Rates going to cool down, inflation cooling down as well, yields stable, immigration, perhaps not the extraordinary numbers we saw in the last year, but sufficient that don't worry about demand just yet, right? Because there's positive demand, not much supply. But here's the thing that you've pointed out to me this morning, which I haven't really had a look at. There's a thing in the Commonwealth Bank Economics Department where they assess willingness to buy.
Yes.
I forget the term that they use, but it's sinking like a stone.
Yeah, CBA's home buying index is what it's called, James. It measures the intent to buy a home, not whether they actually do it. It peaked. The index starts at 100 in start of 2019, so pre-COVID. It peaked during COVID. It rose to 170. The index. That's
because rates were super low.
Super low.
And then on top of that, the government were sort of making it artificially even easier to buy at the time. Yeah.
And since then, it's fallen by 2/3 to the index is now 64.
That's a hell of a drop.
It's a hell of a drop. And so it means that really, if we're comparing against the beginning of 2019, which is the start of the index being 100, and now at 64, 40% fewer people have the intent to buy a home than pre-COVID. So ignore the COVID figures because, they're inflated, I guess. So it really, and it's plummeting substantially. And CBA point to the surprise, in inverted commas, interest rate hike that occurred in November. People were thinking maybe we weren't going to get one.
But it's just like one last hike. It was just like one last teeny weeny hike on top of dozens of them. Not dozens, but they were, how many was it? 13 or 14 cumulatively.
Yeah.
And
so the other problem...
So tell us what that means.
So that means that you're going to have less demand for property. And so that will impact on whether people make a decision to sell as well. Because if you're what we would call a discretionary vendor, which means you'd like to sell if the market's right, but you don't have to sell, which would be a lot of vendors. There's not many that really have to sell. It might be circumstantial if they're moving overseas or doing something like that, but that doesn't make up a lot of the market. Well, if you're a discretionary vendor, you're going to test the market. Okay, there's not a lot of demand. You're going to conclude, I'm not going to sell in 2024. And so that's, in a way, that's good for the market because there's less supply.
That's what I was going to say, yeah.
Demand is low, but supply is low, which is kind of what happened in 23.
Right.
So I don't think we'll see a lot of price declines this year just because I think supply will remain low and we could see a little bit of growth. But because of borrowing capacity, it's going to be an issue. Look, my biggest concern, we need to have, markets hate uncertainty. So we need certainty around interest rates. To get that, we need certainty around inflation. My other concern is the stage 3 tax cuts, which are going to pump $21 billion into the economy, which is about 1% of GDP. It doesn't sound like a lot, 1%, but it's a substantial amount that's going to flow into the economy. Higher income earners are going to get, in dollar value terms, get the largest tax cut, of course, about $9,000 if you're earning $200,000.
Yeah. After tax. It's worth pointing out.
Yeah, that's right. So 5%, 5% of your pre-tax income, it's substantial. That's a bit of a free kick. Where is that money going to go? I reckon most people are going to spend it on living expenses, dining out, holidays, whatever it might be.
Right.
I think, unfortunately, I think a lot of those tax cuts will flow into the economy and add to the inflationary pressures, not
right.
them.
So to the extent that they make an impact on property, you're saying that it's actually they're going to boost. They will be inflationary. Of course they are. Economic textbook will suggest to you that a tax cut is inflationary de facto. But you're saying that for the property investor trying to do their numbers, so if I said to you, I'm expecting inflation to be about 5%, do you think that's too low?
It might not be too low, but it's really what is the direction of inflation? Is it stagnant? Is it persistent? Or is it in decline? Money markets are pricing in 2 interest rate cuts this year. In the second, none in the first half, 2 in the second half of this.
So if you had interest rate cuts and tax cuts.
So what I'm thinking is you'll get the tax cuts before the interest rate cuts. And if they are simulatory, which they will be, maybe those 2 rate cuts won't eventuate. And even of a greater concern is the uncertainty around interest rates and inflation persist a lot longer than what it might be only for a few months. Maybe that is persistent theme throughout the rest of this year. And if it is, the property market's not going to kick off.
Right. Okay, so we learned a few things there. That's really interesting. On top of what everyone knows, if you like, there is that issue, really, really interesting issue that first of all, the buyer tempo, if you like, is subdued. And the CommBank index about people's willingness to buy is 40% down from its height and is at, just looking at the graph there, is at as low as a point as it ever goes. So that's a very important issue that perhaps has been underplayed. And the other point that you make, which is more big picture and theoretical to some degree, is that inflation might even turn upwards, and we might get a scare, just like they had in the US, where their inflation came in higher than expected. So it doesn't fold, folks, in a straight line.
And I should say, James, there's a firm called Research Affiliates in the US, very reputable firm that does a lot of academic work around these things. They studied inflation over the last 100 years, and it tends to, they concluded it tends to be persistent.
Yeah.
So that should be our base case scenario, is that we're going to have persistent inflation.
At these levels.
At these levels.
Yeah.
You know, once it gets over a certain point, I think 7% they were saying, it tends to be persistent, and it can dip and then come back up again.
It's interesting. So. It's very hard to put it back in the bottle, or as Richard Nixon said, it's very hard to put the toothpaste back in the tube.
Yeah.
And he should have known. Okay, we'll take a short break. Back in a moment. Hello, welcome back to the Australian's Money Puzzle podcast. I'm James Kirby, the Wealth Editor at the Australian, with Stuart Wemyss of the ProSolution Group, and we are looking at what you need to know about property in the year ahead. Now, we've looked at the big picture, okay, and we've given you, to the best we can, a picture of the main settings you need to know: the inflation setting, the interest rate setting, the supply and demand setting in the market. What happened last year, what's expected to happen this year. So let's get a little bit more granular. On basics, houses, everyone went for houses during the COVID era because everybody needed space and everybody was stuck in their house, etc. And the gap between houses and apartments kind of yawned in a fashion that we haven't seen very often. What's the outlook now?
Apartments have never been cheaper.
Right.
In history. Well, at least the history starting in 1980.
Does that mean they're good value?
Relative to houses, they are.
Smart answer.
That's right. And also then you think you've got to add something in there. When you talk about rent increases, James, it's expensive to rent an apartment now.
Absolutely.
My wife and I just rented a few apartments in Perth in Melbourne. We got $700 a week for a 2-bedroom apartment.
So what's the yield there?
It's not about 4.2%.
And you'd have been used to lower than 4.
Oh, you
much lower than 4.
Sub 3.
Yeah.
Maybe
okay.
is kind of what you should expect.
Yeah.
So for those that are able to get into the market, and I think first home buyers increased by 20% last year in terms of the lending to first home buyers. So those that are able to get into the market probably will want to do so because renting is so expensive.
Yeah.
And apartments are relatively cheap compared to houses.
Yeah, right.
So it's all conspiring, I think, for maybe a bit of a turnaround there, a bit of mean reversion.
So you're saying as an investor, your yield could be better than you think on apartments, and that gives you a great base because your chances of having a vacancy are very slim.
Yes.
Right now, anywhere. In fact, they're even more slim in the regions than in the cities. That's still the case. And vacancy rate's still super low, 1%, in across the board. And the only place that's a little bit looser than that is actually in the big cities. So you're saying the yield is better than you think. The rates and inflation we've covered. So the outlook then, the question, the investor who's listening, anyone who's listening is saying, well, that's interesting because, a house is so expensive to buy as an investor. There's so much more maintenance involved. It's a bigger deal all around. Buy an apartment, I can see the yield is good. I can see the demand is good. Does that play to a larger picture that it may be a better investment than houses dollar for dollar?
Maybe in the short term it will.
Yeah.
I mean, the markets they're cyclical, of course. What's going on at the moment in terms of the price of apartments compared to houses isn't sustainable. It just won't. It won't be sustainable because, as I said, those higher rental yields will attract more investors. More buyer demand will push prices higher.
Right.
The only question is, when will that happen? When will that turn? Will it be 2024?
Yeah.
Will it be next year? We don't know, but it will definitely happen. And as long-term investors, as property investors, we need to be long-term. We're not buying and hoping to sell in 2 years' time or anything like that. So as you said, your starting yield is quite high. If you go and borrow, you're going to earn, go and borrow $600,000, go and buy an apartment, you're going to earn 4-ish% in terms of rental yield. Your borrowings don't change. Even the value of the house changes, the apartment changes, of course, but so that's your starting point. Your starting point's pretty good from a cash flow perspective.
Yeah.
Interest rates will eventually come down. So the gap between interest rate and rental yield won't be that substantial.
So maybe the theme here for the year ahead, it would seem at the start of the year, is that there's a window of opportunity in apartment investing that we haven't seen for some time.
I've been doing this for 20 years, James. It hasn't been like this over that period of time.
Yeah.
And looking back at the data, it really hasn't been like that ever at all.
Yeah.
Maybe in the early 80s, yields were very high, but I don't think we can really compare back. That's just a completely different market.
And those yields reflect the fact that there was double-digit rent increases going through in recent times.
Yeah, correct.
And of course, the vacancy rate's been so super low. Okay, folks, I won't say you heard it here first, but you heard it here. Among the first places you heard it. All right, we'll take a short break and we'll be back with some very good questions in a moment. Hello, welcome back to the Australians Money Puzzle podcast. James Kirby here with Stuart Wemyss. We're talking property. We're talking what you need to know for the year ahead. Now, we looked at the big picture and we gave you an idea of what you need to know in terms of fundamentals. We looked at the nature of the market as it is at the start of this year. And if one thing came out of that, it was that apartments are showing value opportunity, clear and present there. And that is not around very often, folks. It's been a long time since someone has said that. And in a way, it was inevitable because the houses had gone off the chart, if you like, during COVID. But it's a very clear opportunity this year then. The standout opportunity perhaps is apartments. Now, next thing, regional. And we'll just try and take a look at two cities because Sydney is ticking along very nicely. It did 10% or so last year. And it is also expected to be on the higher side of this year. So if I said at the start of the show that the expectations for prices was 2 to 5% across the board, you can take it that Sydney are on the higher end of that, being 5 or more. But here's the thing I want to ask Stuart. Two cities really went in their separate ways last year. That is Melbourne, for all its scale and scope and immigrants coming here first, did 2.5%. I mean, hopeless, really, in the context of the possibilities that were there. And you mentioned at the start how part of that weakness is regulatory risk around the Victorian government being basically looking to property to solve many of their problems. Let's look at the other side. Perth was the standout city last year. What's the standout city this year?
Oh, it's still Perth, James.
Yeah.
100%.
Yeah, right.
The market is incredibly tight in Perth. If you want to go and buy an asset in Perth, it's really difficult.
Right.
Very difficult. As soon as they're on the market, they're sold within 3 days.
As soon as they're on the market, someone from Sydney or Melbourne is on the phone.
Exactly right.
Yeah.
And so we need more supply in that. You need more discretion. But, as prices start rising, people think, they've had 15 years of virtually no growth.
Yes.
So again, if you're a discretionary vendor in that market, you say, well, I'm not going to sell now. I'll wait for the market to kick off. It's starting to kick off.
Yeah.
I don't think after 15 years of very flat growth, I think there's a lot of pent up demand there. And the state's in good health. Population growth is strong also in Perth as well.
Yeah.
And so I think that'll be the standout. This year.
Okay.
I note that Brisbane's median house price exceeded Melbourne's actually for the first time.
I saw that, but on close inspection, I wasn't quite convinced with that. Were you convinced with that?
Well, I don't. There's always variances in that data set.
Yeah, I think there were some real oddities in that. I mean, I actually looked at it. I actually rang them because I saw it and I said, "Woof, oh!" And then I said, "Oh, yeah." There was all about the composition of the housing stock, and it wasn't particularly. I wasn't convinced anyway.
But Brisbane market is doing well, and it has certainly recovered from that period of interest rate hikes and so forth. So I think you're right. I think Brisbane and Sydney will tick along. Melbourne will underperform, and Perth will be be the standout.
Okay. Terrific. Helicopter view there, folks. All right. Now, quick run at the questions. Ramnish, the first question is from Ramnish, Ramnish. Thank you, Ramnish, for your question. This is a question. I could do this. We might do this on Thursday on the show, which is where obviously Tuesdays are property and Thursday is everything else. But we could do it any day and we could spend a whole show on it. Anyway, he says, what's the ideal investment split between shares and property? Have you an answer for that, Stuart?
In the absence of, I guess, personal circumstances, goals, all those sorts of things, appetite, risk appetite, all those things that go into really answering that question, I'd probably go 50-50.
Would you really?
For the absence of a better answer. However, what I would say is that you probably need to aim for that asset allocation by the time you're in your 60s.
Yeah.
Not necessarily when you're in your 30s or 40s, because property is obviously a very lumpy asset.
Yeah.
You've got to go out and buy a property. You're probably going to be heavy property, in your 30s and 40s and probably most of your 50s until you can get more money in the share market via super or otherwise.
Yeah.
So I would like, typically if we're working with clients, I would like a really good level of diversification by the time we're in retirement.
Would you say that you are typical though? If I went into some wealth manager I wonder if I went into, Crestone, or if I went into Morgan Stanley, would they say that?
We'll never ask your barber if you need a haircut, James. No, probably not. And if you went and spoke to a property buyer's agent, they're probably not going to give you that answer as well.
Yeah.
But when you look at longer term returns over the last 4 decades, they're very similar in terms of property and shares.
Yes.
Volatility is lower in property than it is in shares, but we don't need to worry about volatility over long term.
Yeah.
So if they're providing similar returns, one allows gearing, the other one allows gearing, but it's not as attractive to do so. So to my mind, personally, my aim 50-50.
Okay.
Now I'm heavy in property at the moment, but I'm also actively investing in shares.
That's really interesting. So there's an answer for you, Ramnish, and what I like most of all about that is you got an answer. So that's Stuart's view. Okay, Carolyn, Carolyn, as opposed to Caroline, and friend. So from the two of them, we'd love to hear about buying property as tenants in common. We're a couple of friends who each have half the funds we need to buy a home. So this could be the answer for us, but we are afraid of what might happen if one of us dies. It was terribly practical, Carolyn and chum. Could we have written into an agreement that the surviving owner has full rights to the other's share for a specified period of time? Could the surviving owner be given priority to buy or find another buyer for the deceased owner's share? Is that feasible?
So, James, you could have a call option agreement, which gives the surviving party the option, but not the obligation.
So you don't have to create shares or anything like that.
No, it's just a
call option.
Legal agreement. Might be 5 pages or something like that. It's called a call option agreement.
Yeah.
However, if I was in their situation, the problem could be that the person that passes away, their share goes into their estate. The estate is now left with a share of a property. You can't do anything with a share of a property unless the other owner
agrees, famously so. Yeah.
So maybe what they need is what's called a buy-sell agreement, which gives the other party the obligation to buy the remaining share. And I think that would work better.
Okay.
Because that way when the party passes away, at least the cash goes into their estate.
Yeah.
That's going to be easy to work with.
Yeah.
And the remaining.
But it's an obligation. Is it compulsory?
I would make it an obligation just because, if I was the deceased owner in this situation, that it could be my beneficiaries can't do anything with the asset.
Otherwise, the money might never get out.
Yeah, that's right.
Okay, very interesting. I hope that's useful to you, Carolyn. Thank you for the question. We must look at this again. It's an issue that comes up more and more about buying together. I think, needless to say, with the average house prices the way they are, it's going to be more common. Just a quick comment from Paul. Downsizers have little stock on the market in which to downsize. We would like to downsize, but cannot easily do so. Yes, I suppose so. We all talk about downsizing. We imagine this place. What is it, though? Is it an apartment or is it a house? Yeah, I imagine that's an issue, all right? The perfect downsized property. It's a relatively new thing. So there isn't, basically we talk about houses and units, don't we? It's not like there are specific properties designed for people. I suppose some of the townhouses in outer suburbs where they know that the buyer is going to be someone who've had a house around the corner. But point taken, Paul, thank you. Last one from Duncan. I think it's a trick question. It is a trick question. It's an interesting question. Is there any lender in Australia that can approve a loan for up to $200,000 over a maximum term of 2 years and no note on your credit file, unsecured, no fees, and below 10% per annum? There is. It's called the ATO. This is for personal applicants too. What is he talking about there? Would you like to explain to our innocent, naive listeners what on earth Duncan is referring to?
If you lodge your tax return, have a tax liability that you're not able to pay, you can call the ATO up and put it on a loan arrangement.
I have done it a long time ago.
They will charge something called a general interest charge, which actually, Duncan, it's now 11.4%. So it's over the 10% mark. It's linked to obviously the cash rate. And the ATO will give you a payment plan. It can be up to 2 years, but for our clients that need that situation, we wouldn't make it more than a year.
But you're paying 11%.
And also, you want to have that debt repaid by the time you lodge your next tax return as well. Otherwise, it's a problem.
But not only, well, there's a few things I would say, Duncan, that, yes, you're technically correct. And okay, so there's no fees and there's no applications. Yeah, sure. Well, that's all right. First of all, you're paying 11%, right?
Yes.
Secondly, you owe the money to the ATO.
Yeah.
I would prefer to owe the money to any bank in the world rather than the ATO. So there are 2 points. But yes, point taken, very clever and good observation. It's true. But gee, I don't know. 11 is, so what did they do? They get the cash rate and they had a nice big
at a margin.
margin.
I can't reflect, but it is cash rate driven because it was very low,
of course,
during the during the COVID period.
Yeah,
and the interest you pay is not tax deductible either. I'll throw that out there. So
is that right?
It's 11%
right?
after
I didn't
tax.
remember that.
It's costly.
There you are. So folks, yes, it exists. But Duncan, I don't know. Are you trying to tell us they're generous? I don't think that sounds to me like I don't think they're generous. It's an arrangement. That's all. And well observed. And thank you very much for the correspondence. Really interesting. Let's have some questions, by the way. We've been on holidays and the letterbox has some, but it is by no means full. So let's hear some questions, observations, complaints, anything you wish to send to us. It's up to you to let me know what you'd like to hear in the show this year, and I'm wide open to suggestions. Okay, folks, thank you very much. Thank you very much, Stuart Wemyss of ProSolution. Great as usual. I hope that's a good start for the year. Remember the email, themoneypuzzle@theaustralian.com.au. Talk to you soon.